Now by Sally Old, interest rate strategist with JP Morgan in Sydney. Stephen Nash is with me from Fixed Securities in studio this morning. But Sally, we will start with you. Just explain in your take of what's going on in those US Treasuries at the moment.
Good morning, Brooke. I mean, it's been a pretty vicious sell-off. I mean, basically, I think the Fed announced QE2, and then in the sort of 24 hours afterwards, we had a nice rally in bond yields and a sell-off in the US dollar, and it looked like markets were behaving exactly as everyone sort of expected them to behave post the implementation of QE2. But since then, it's really been one-way traffic in US Treasuries, and there's been a very nasty sell-off with yields sort of backing up around sort of 40 or 50 points over the last week or so. To be at their highest level in a couple of months. And I think what's going on, I mean, there are all sorts of explanations flying around the market. I mean, clearly there's a very big sort of capitulation on long duration positions in the US. There's been talk of rate locking associated with corporate supply, all this sort of stuff. But I think the other thing that's going on is that as we're heading in towards year end, I mean, we're only sort of 6 weeks before the end of December. And there seems to be, not just in rates markets but also in FX markets, a lot of position squaring going on. So people really making an effort to lighten their positions and square up their books as we head into year end. And if you've been running a short dollar position or a long treasuries position, recent price action would probably be making you more keen than not to sort of square up some of your risk.
Stephen, what do you make of, as Sally said, all these various explanations running around about what's happening in the treasuries, and what Sally said as well about book squaring?
Oh, I think that's quite valid, but I also think that the market, in a sense, purchased treasuries on the idea that there'd be another buyer in the market, the Fed. Now there's talk that the Fed may not be able to do QE3, or there may be constraints on the Fed going forward. So the market's now worried about the Fed being constrained and not being able to do any more purchasing.
Despite the rules changing on that.
Yeah, so there's the market's been acting on the basis of who's buying and selling rather than looking at the underlying fundamentals, and the Fed has tried to focus the market on that, but the market's not looking at that right now.
So you think it's almost two things happening. There's something happening with the economy, but that's not necessarily being reflected by the treasuries?
Yes.
Okay. Yeah. Because people are talking of some sort of, maybe a bit of even a pickup for the US economy. Is that what you believe is happening?
There have been a few better than expected figures coming through in the last little while, but it's too early, I think, to get really bullish about the US economy. There's still quite a few indicators that are still quite bearish for the economy going forward.
Okay, and Sally, you have been fairly bullish in the past about US Treasuries. Given what we've been seeing, do you still hold that view?
Well, I think, Brooke, the key sort of issue is here, like, unless we're really wrong in terms of our view on the US economy, and unless, we and the Fed and everyone else is reading this whole thing completely wrong, and actually the US economy is off to the races, and, by the time we get to mid-2011, everything's sort of going to be okay, and the unemployment rate will be well and truly on the way down. Unless we, are less sure about that, then we sort of look at it and say, well, at the moment we have core inflation which continues to fall. We have the unemployment rate which is sort of stuck above 9.5%, and even on our forecasts at JP Morgan, and we've got some reasonably upbeat forecasts for the global economy next year, we don't see that moving below 9% until well into 2012. If you look at the backdrop there and you look at the Fed, who is prepared to buy $600 billion worth of treasuries over the next 6 to 7 months, our strategists at JP Morgan in New York are still very much of the view that the risks are biased towards lower yields. And I sort of suspect that if the Fed hasn't changed its view on the underlying economy, that at some point they're going to come out and basically talk yields down. I mean, effectively, a very nasty sell-off in 10-year yields is going to be very counterproductive to any sort of nascent recovery that's going on, and the Fed basically won't tolerate it, and Bernanke will come out and pretty much will talk down yields. And I think if positions lighten up, I think there's a good chance that as we move into the beginning of 2011, yields actually start to fall again. Maybe we don't get back down to sort of 2.25%, but I think there's a good chance that we do definitely head back towards the 2.5% level.
Stephen, can Bernanke come out and talk down those yields when, well, my question is, when markets seem to be questioning the credibility, whether he's got the power to push through with this $600 billion? You just mentioned the political aspect. Yeah,
I think Bernanke is judging the situation as being unusual, and his action, I suppose, is a bit unusual. And I think a lot of market participants haven't accepted that. They are of the opinion that the economy will be fine without any further easing. But I think Bernanke wants to make sure that we're not sitting here in 3 years' time saying, well, we should have acted more aggressively in that time. I think it's important for the Fed to really act aggressively, and that's what they're doing. I think what they're doing is appropriate, given that level of unemployment, over 9.5%. Okay, that they do have to follow unemployment and inflation, but inflation is not a constraint at the moment. I mean, they've told us that inflation is lower than expected, and for bond investors that's gold, if not platinum. Yeah.
Yes, sure, exactly. Can I also ask you guys are the perfect people to speak to about the Irish situation, because any given day everyone says it's either the big issue on the table for financial markets and we're looking at another crisis, or maybe the next day, Sally, people start to say, oh well, actually those fears have eased today. How much weight are you putting on this idea of a spillover effect from the Ireland debt situation across the rest of Europe?
Yeah, well, I think if you believe sort of some of the stuff that's been floating around markets in the last 48 hours, I mean, it seems to me that there's, a lot of work happening behind the scenes in Europe and at the G20 meeting, which is basically saying that at some point over the course of the week, the whole Ireland situation is basically going to be resolved. And it's an interesting situation because it's almost the reverse of what we had with Greece. Greece was basically, back in April and May begging the EU to give it some money, and the EU was sort of pushing back and saying, look, until you get your fiscal house in order or actually make some efforts to improve that or show us how you're going to do it, you're not going to get any cash. Whereas with Ireland, it's basically the other way around, whereas the Irish are basically saying, we can look after ourselves, we'll get this thing sorted out, just give us a little bit of time. And the Europeans are basically saying, no, you don't have time, you've got to take money and take it now and look at restructuring your debt. And basically the fear is that what was happening to peripheral spreads in Europe, where they were blowing wider and sovereign CDS, is that was actually hampering the prospects for other peripheral countries like Portugal and Spain, who are sort of doing the right thing and making the progress. And it sort of felt that the EU didn't want to sacrifice, the good progress that was being made in places like Spain and Portugal, at the expense, because of the Irish situation. So it seems to be the reason why spreads have come in over the last little while is that the market is now pricing in a pretty good chance that whole situation is going to be resolved favourably, and therefore, if that happens, we should continue to see further compression in those spreads. But very firmly, I think European policymakers just don't want the situation to get any worse. They've got the mechanism to solve the issue, and I'd say it's probably more likely than not that will actually be forced upon the Irish at some point this week.
Yeah, I agree. I think the Irish are trying to go it alone. There should be I would have thought, some procedure in place for these type of events so that the questioning of the market can be taken out. Yeah. I mean, we're not talking about the Irish necessarily going and using money, but they should agree to consider that in the case that they may need it. So they have an emergency action plan in place, so the market's not concerned about that going forward. I think that should be, I imagine that over time that those sort of procedures will come into play. At the moment it's all one country doing one thing and one country doing something else, to the detriment, as Sally indicated, of the whole union, yeah? Yeah,
so as in, neither side should be begging, there should be some sort of agreement, like if you get to XYZ position then we have to chat, that kind of thing.
Yeah,
okay.
I think so.
All right, good. And I should ask you guys about the minutes which come out from the Reserve Bank today as well. Well, we'll start with you, Stephen. We got that surprise rate hike at the time and much discussion since, particularly with the banks. Do you think we'll get any greater clarity on what's going on, or do we kind of need that information?
Well, I think, as I said, at the time it was a tough call. I wasn't going for a tightening, but I think we'll see that discussion in the minutes. There may be some reference to how close the decision was, and that there is some opposition within some parts of the board to.
So in terms of the voting,
there might be more elaboration on how close the decision was. I don't think there's going to be any new news, in the sense that we've had the statement of monetary policy, and that's given us direction. So I don't think there's going to be anything really new, but there may be some colour on the debate that went on. Yeah,
and Sally, since we got the employment numbers, last week as well, there's been a bit of discussion about whether the RBA is reading the economy correctly in terms of the strength of the economy. What do you think?
Yeah, look, I mean, if anything, I think you commend the RBA for what they did in November earlier this month, because it was a fine example of preemptive policy making. I mean, those guys are sort of looking down the barrel and saying, well, if what we think is going to happen actually does happen, in the sense that we're going to have a huge investment boom, that the Chinese economy is going to continue to grow, at reasonably solid rates, that the global economy is going to continue to improve, then that suggests that the risks are biased towards better growth and higher inflation outcomes, and the prudent thing to do right here and now is to sort of take a step in the right direction and lift rates a little bit higher. So the idea is if these guys can be preemptive about it, then it should, all other things equal, mean that the ultimate peak in the interest rate cycle and the inflation cycle is hopefully a little bit lower than it might otherwise have been. So, I'm sure, policy making is, basically the art of making decisions under very uncertain, in a very uncertain environment. So you never have all the information at the time, and so it does make it easier for people to sort of criticise and saying, well, you're misreading this or you're not doing that right. That's just part of what it is to be a policymaker. But I think ultimately the RBA has made the right decision given the balance of risk where the economy is headed next year.
Because that preemptive strike, Stephen's all about this expected boom in the mining sector. Is there some sort of limit, though, that the RBA has to be aware of, where they can keep pushing that construction and housing sector down in order to, deal with the mining sector, so to speak?
Well, I think that's a really good question. At the moment, we're seeing clearance rates in the property market suggesting sort of flat prices to possibly down. I hope that doesn't turn too negative. I don't expect that it will, but we've had quite elevated, turbocharged, I suppose you could call it, rate rises from the major banks. Now, so that's amplified the move by the RBA. So I think that's really going to be carefully monitored. We don't want negative price momentum in the property market. I think that could damage financial stability. So that has to be something to be borne in mind. I think that's what will happen over the Christmas New Year period, and after that, possibly, if everything goes to plan, I imagine there may be more tightenings from the RBA. But that's a big if, if everything goes to plan.
Yeah, sure. Yeah. But we're not even at the rates of before the GFC. The variable mortgage rates are above 9%. We're still only at 7.5% at the moment.
Yeah.
So, is this a concern right now?
Well, I'm just. I suppose if you have a look at the various housing lending, look at property prices flat. There's a lot of complaints from the industry about the lack of demand and how rates are affecting that. I'm just concerned that there could be some change in the market towards a more negative price momentum, and that's very difficult to control once it starts. So I think where we've got property prices right now is probably about right, but for them to move down, it's probably not the right direction.
Sally, just a final comment from you on that, maybe?
Well, I guess that's the reality of the world that we're going to live in for the next couple of years, is that the interest rate sensitive sectors are going to get squeezed, and they have to basically grow at below trend rate so that the rest of the economy, or that's really leveraged to the whole commodity story, can grow at above trend rates. And that's basically the sort of blunt truth of the world that we're going to live in. And monetary policy is a blunt instrument, and the RBA will do the best that it can, but that won't mean that there will be times that it feels pretty horrible in this part of the country relative to maybe over in the west or up in Queensland. But unfortunately, I think that's the way the land is going to look for the next couple of years.
Sally Old, thank you very much for your time. You've been very generous once again. Thank you. And also Stephen Nash from Fix Security.